What is an asset pricing anomaly?
I feel like you led that in with a lot of pressure, but I mean, at a high level, I would say an asset pricing anomaly is a trading signal that predicts future stock returns, and more specifically, I would say abnormal returns. And I think that
Hmm.
abnormal part is important.
And so, what types of anomalies did you study in your research on the timing of anomaly returns?
We mostly focused on accounting-based anomalies. So think about variables that show up in, say, a firm's annual report, and they were kind of the types of anomalies where you could kind of just go to an annual report and find the information you needed to actually do the trading strategy.
Can you talk about why you didn't have valuation based anomalies in the research?
Well, a lot of the valuation-based anomalies, by their very definition, involve some sort of price measure, stock price measure. And so the real purpose of our paper was to try to understand how the release of information about a particular trading strategy related to the specific returns of that strategy. And the tricky thing about ratios, think about something like the price to earnings ratio. I know when earnings comes out, I can see and measure that date. But when does the price come out?
Hmm.
It basically is kind of continuously updated. And so it's a little bit harder with some of the valuation measures to really think about when we first learned the valuation measure.
Okay. All right. So I mean, the next question is kind of the result of the paper, and the result is, man, mind blowing stuff, and its implications are too. Okay. So when do anomaly returns show up relative to the release of anomaly signal information?
Yeah, I mean, so I think, yeah, one of the key punchlines of the paper is we basically show that if you really are graphing the returns to different strategies, what you see is that most of the return is earned right after the information that you need to start the strategy is first released. Right. So basically, you kind of see this, take something like the asset growth anomaly, which is formed by looking at a firm's assets from their financial statement. As soon as that assets information comes out, that's when you see the strongest return predictability. And then the farther you get away from that date, the more that kind of result just decays away.
Wow. Okay, so how has the timing of anomaly returns trended over time?
Well, I think that's the other kind of big result we have in the paper is that if you kind of look over the last couple of decades, um, the returns to different trading strategies have been kind of moving earlier and earlier, or put differently, they get closer and closer to when the information was first released. And in that sense, I think kind of, it's an intuitive result. Once information is released, traders race to be the first to profit from it. And what we basically show is they're getting faster and faster at doing so.
So that trend in anomaly returns being closer to the information release date is basically information is moving faster now than it used to.
Exactly. Well, information, I think it's actually two things. One, the information itself is being disseminated faster. And two, people are processing it and trading on it
Hmm.
faster.
Hmm.
Makes sense. So, how does the academic convention of forming portfolios annually in June affect anomaly returns?
Well, I think this is kind of one of the interesting side effects that came out of our paper is when we really started looking at when these strategies earned their returns, we realized it was super important to look at the period right after the information first came out. But then we noticed that if you go and actually look at what academic studies do, they almost always form portfolios once a year, usually in June. And it actually turns out for a lot of these anomalies, June is way after the information was first released. Sometimes weeks, sometimes months. In the extreme case, it can be almost a year. And so what that basically means is that the existing academic studies are often using really old, stale information, and that makes anomalies look weaker than they actually are. So if anything, these academic studies kind of were, understating the return predictability that was really in the data.
Hmm. What do you think the results suggest about the cause of anomalies?
And well, I think that's another interesting question. And it's something academics have been debating since the first anomaly was discovered way back in the 1960s. In some sense, there's a group of academics who think anomalies are kind of not actually there. They might just be artifacts of looking at the data too much. There's a group of people who think anomalies really are there. And I think our results actually are kind of supportive of that latter view, because the fact that you actually see returns concentrated in that period around the information release is suggestive of something about a connection between returns and that release. And in particular, I think what it shows is that it takes time for information to get fully impounded into prices. And that's what an anomaly really is. It's delayed processing of information.
Mm-hmm.
So
And
it's like
what about barriers? Sorry, Ben, do you have something to say?
well, I just want to ask about, so that's like a mispricing story for anomalies. Does that relate at all to the sort of risk versus mispricing debate on anomaly returns?
I mean, this is a very complicated debate, and so I'm a little hesitant to take a strong stance on it. But in some sense, I think a lot of stories about mispricing. So imagine that the asset growth anomaly is really just a proxy for mispricing. So the asset's value tells you something about mispricing. What you'd kind of expect is that stocks with a certain asset level would just earn different returns than stocks with a lower asset value. And there's not necessarily a reason to believe that you'd see this return pattern that we document right when the asset information first comes out. And now there's a subtler angle to that, which is, of course, if I learn something new about the riskiness of a stock, then you might actually get a similar prediction. But I think in the most part, our results suggest these things are not a risk-based explanation. They really are just delayed processing of information about the anomaly.
Interesting. What about barriers to accessing financial data? Like, what are the current barriers to accessing financial data that would allow anomalies to persist?
Well, this is one of the other things. I've been kind of going down a rabbit hole to study more about the history of financial markets. And I think I won't speak for you guys or your audience, but at least for me, I think I used to have an underappreciation for how much financial markets have changed over the last, say, 3 or 4 decades. So just go back in time a little bit. But if you were a trader in the 1970s and you said, I want to trade on this asset growth thing, how do I actually do that? In the 1970s, it would have been incredibly difficult. So back then, if you wanted a firm's 10K and you weren't already the owner of this thing, you would have had to wait until they physically mail their annual report to the SEC. The SEC would have gotten this thing, taken a couple weeks to process it. They would have put it on the floor of one of their main libraries. So they had a library in Chicago and New York and DC. And you would have had to have sent an analyst to go physically get this 10K and look at it. So it was incredibly hard to get this information back in the day. Today, of course, we have the information revolution. That stuff's a lot easier to access. But still, if you really want to get this data, which we call point-in-time data, before everyone else gets it, the only way to do so is to pay a third party who actually collects and processes all this data. And of course, they understand the value of this. There's a price to do this. So even in the information era, where we kind of think all this information is free and instantly available, there are non-trivial costs to getting it. And then on top of that, even once you get this information, you've got to process it. You've got to figure out how to use it.
Yeah, that's really interesting. So that would put, we work a lot with dimensional fund advisors, and that's like one of the things they talk about is they've built all these internal processes and systems for doing that. So you kind of need that capability to do this without getting killed by information access costs.
Exactly.
Does that make sense?
Yeah, I think that's exactly right. And I think this is one of the things where it's really easy to kind of say, hey, in the information era, information is free. And I think that's an oversimplification. I think in a lot of these cases, there are still serious frictions that make it, not impossible, but make it challenging for information to be processed as quickly as you might think.
I believe it. I mean, we pay for Morningstar Direct and Y charts and stuff like that's not cheap, and that's not even going to give us timely access to data to do stuff like this.
Exactly.
Well, and not only that, but once that type of information becomes super low cost or free, then it'll be new information that's harder to access that people will want to use for trading strategies.
Right.
Exactly.
Your point, Matt, on how things have changed. So since the 70s, I was reading this morning a paper in the Financial Analyst Journal from 1976, and it was an interview with Ben Graham, and he was talking about how much harder it's gotten to do individual security analysis to get an edge since 40 years prior to that, so the 1930s, because now there's so much research being done. And then the same things happened again over the next the next 40 or so years.
Well, I
Yeah.
think that's exactly right. I mean, I think markets have gotten more and more competitive every decade since Ben Graham
Yeah.
first, started doing his work. And in some sense, that's a great thing. I mean, it helps capital get more efficiently allocated in the economy, but it also means it's harder and harder to get an edge if you're a trader.
So I don't mean to call somebody out here, and that's not what I'm trying to do. But we did an episode with Andrew Chen, who I think you mentioned in your paper. How would and he kind of talked about how anomalies are gone basically. How would your rebalancing approach closer to information release dates as opposed to the academic convention? How would that affect research like Andrew's?
Well, I mean, I don't think Andrew and I actually disagree on very many things. I mean, I think at a high level, if you look at just anomalies as they were originally discovered in the, academic papers that first wrote about them, they're not very strong anymore.
Right.
And I think part of that is, as we show, if you follow the original strategies, you end up rebalancing using information that's weeks, if not months, if not a year stale. And by then, most of the alpha is gone. So I think in that sense, if you take the strictest definition or the strictest look at these anomalies, a lot of them don't look very good. But I think our point is, I think, subtly different, which is if you were to actually optimize and try to trade these things as fast as you possibly could, they're still very much in the data.
Wow. You mentioned valuation-based anomalies earlier. How would your findings apply to valuation-based anomalies like price to book?
Yeah, that's an interesting issue. And unfortunately, there's not a very simple answer to that question. In some sense, as we said earlier, the trick with valuation-based anomalies is since they involve a price-based measure, I don't have a discrete way of measuring when the information first comes out. And so that makes it harder to apply our methodology to those types of things. That having been said, I think there's a whole realm of research that could still be done to further explore this idea in those contexts. If you think about things like price to book, the price number, I don't know when that first comes out, but the book value number, I certainly do. And so you could apply our methodology to the book revelation, right? So when that information first comes out. Moreover, you might also be able to argue that certain times of, there might be certain times where things like the price measure are more salient or more visible to investors. And so it's possible you could find a similar result around those events. It's not something I've looked at, but again, I think there's a lot of interesting stuff that could be done.
Yeah, that is really interesting. What do you think the implications of your findings in this paper are for investors who are hoping to capture anomaly returns in live traded portfolios?
Well, I mean, in some sense, I think anyone who's seriously trading in markets knows this already. They're ruthlessly competitive. And our results basically say to do this, you need to be competitive. You need to be one of the fastest to react. If you are trading on these things 3 months after the information first came out, you're too late.